So what is going on with Bitcoin's price? It seems like it's been a complete puzzle lately, with signals pointing in pretty much every direction. Today we're going to dive deep into a technical analysis that tries to cut through all that noise, and believe me, it reveals a pretty surprising and potentially dangerous truth. Let's get right into it.
So here's the big question. Is Bitcoin about to break out and shoot for the moon, or is it headed for a breakdown? Well, the analysis we're exploring today has a really dramatic answer. It's not one or the other. It suggests the whole thing is a trap.
Okay, so to understand why it might be a trap, you first have to get a feel for the market environment right now. And honestly, it's a mess. Bitcoin is just sending out so many mixed signals that trying to predict its next move feels, well, almost impossible.
And this quote from the analysis just hits the nail on the head. Conflicting signals detected. The market, it says, lacks directional conviction. Basically, there's no real agreement between the buyers and the sellers. It's like the market itself is just completely paralyzed with indecision.
And yeah, the data totally backs this up. The official market phase is a whopping 80% neutral. I mean, look at this. You've got 10% bullish and 10% bearish. They're just locked in this perfect stalemate, completely canceling each other out. The market has no direction.
So let's play detective here for a minute. We're going to start by looking at all the evidence that suggests the price could be on its way up. What are the clues that are giving the bulls, the buyers, so much hope right now?
All right, first clue for the bulls is this number right here, 57. This is the bias accumulation score. Now think of it like a measure of the underlying buying interest that's happening behind the scenes. A score this high is a pretty strong signal that even if things look calm on the surface, a lot of people are quietly buying up Bitcoin.
And it's not just that one score either. The report also points to a bullish microtrend, a bullish outlook on the 4-hour chart, and says buy pressure is definitely active. Plus, there was a recent pump from a key balance zone. So from this angle, the bull case looks pretty convincing, right? Well, let's not get ahead of ourselves. Let's look at the other side.
Okay, now it's time to flip the coin. We have to look at all the clues that are pointing in the exact opposite direction. What's the evidence that suggests the bears, the sellers, are the ones who are actually in control here? Whoa, okay, here is the bears' biggest piece of evidence. This number is just staggering. This is the net market dominance. To put it simply, it measures the force of sellers against buyers. And a negative number this huge means that sellers aren't just in the lead, they are overwhelmingly dominating the market's activity. It's not even a fair fight.
And as if that crazy number wasn't enough, the main, longer-term trend is still considered bearish. The dominant volume? Yeah, that's coming from sellers. The last 12-hour candle closed red, and on top of it all, sellers are very actively defending key resistance levels, basically building a wall that stops the price from moving any higher.
So you see the problem, right? It's this total stalemate, a classic tug-of-war. On one rope, you have that strong, quiet buying pressure and some positive short-term signals. And on the other, you have this absolutely overwhelming seller dominance and a bearish main trend. So, which one wins? This is where things get really interesting. When you have two powerful forces clashing like this, you have to look deeper for a tiebreaker. Some kind of deciding factor that cuts through all that noise and tells you what's really going on underneath.
And that deciding factor, it all comes down to something called market structure. You can think of it like the foundation of a house, or maybe the supports holding up a bridge. If that structure is solid, it can support a big price move. But if it's weak, the whole thing could just collapse.
And here it is. This is the big aha moment from the analysis. The final verdict on the market's foundation is fragmented structure. So it doesn't matter how strong the bulls seem or how strong the bears seem. The critical point is that the very foundation they're fighting on is unstable. So what does fragmented structure even mean? Well, it's pretty much what it sounds like. The foundation is broken into pieces. The analysis flashes multiple red flags, warnings on trend structure, early warnings on risk. It even says there's no clear structure at all. It rates the strength a measly 2 out of 5. It's like trying to drive a truck over a rickety old rope bridge. It just doesn't matter how fast you go. When the foundation is this weak, any move is incredibly risky.
All right, let's recap. We've got a decent case for the bulls. We have a powerful case for the bears. And now we know the whole thing is built on a broken foundation. So how does this analysis put all these pieces together to get to its final, dramatic conclusion?
So the analysis takes all of this messy, conflicting data, the bullish pressure, the overwhelming bearish dominance, and most importantly, that critical structural weakness, and it funnels it all into its AI model to come up with a single, clear verdict. And that verdict is trap risk. In trading, a trap is when the market looks really tempting. It might even make a little move up, for instance, luring in hopeful buyers. But because that underlying structure is so incredibly weak, it's very, very likely to suddenly reverse and trap all of those unsuspecting traders.
And if you had any doubt left at all, just look at this number. This is the overall setup quality score, a 3.5 out of 10. That is a crystal clear warning from the analysis. This is a very high risk, very low quality environment to be making any moves in.
Okay, so this brings us to the most important question, right? Given all these conflicting signals, the broken structure, and the really high risk of a trap, what on earth is the recommended move here, according to this analysis?
And the answer is actually really, really simple. Wait. In a market this conflicted, this messy, and this structurally unsound, the smartest move isn't to be a bull or a bear. It's to be patient. It's to stay on the sidelines. You know, sometimes the best trade you can make is no trade at all. And that just leaves us with one final question. When the market finally does find its conviction, which way is it going to go?